Welcome, Experior, to Products on Thursday training for October 26th. We have a Beneva presentation today, investments, and Shant Manasian is going to do the presentation. And we haven't heard from him in a while. It's nice to have him aboard. So take it away, Shant. It's all yours.
Thank you very much for that kind introduction, Sheldon. Good afternoon, everyone, and thank you for jumping on board. I really appreciate it. Thank you sincerely on behalf of the sales team, management, for your continued business support. We've got a special relationship with Experior, and we value that. So thank you very much right off the bat. So really, today's presentation is a little bit about the volatility, some slides around volatility. Feel free to connect with me. I'll be more than happy to send you the slides. How you can address it, some of the opportunities that you can capitalize on, including retaining your assets. So I will be discussing Beneva's investment accounts. For those of you that may or may not be familiar with it, it was formerly called Le Capital, as well as, which is basically the registered products there, and Beneva's GIF Investment Solutions, basically formerly called SSQ, and ideal for the non-registered line of business. So if you feel you're giving some support on the non-registered side elsewhere and you feel over diversified there in the fund companies, then perhaps you may want to look at the Beneva's GIF Investment Solutions as well. And I sort of tell you what the similarities and differences are as we go through the various slides. So I hope you do find it beneficial, and we're off and rock and rolling as we speak. So a little bit about Beneva. Some of you are aware, again, some of you may not be aware. So we do offer, north of, in terms of assets under administration, about $26 billion and growing, with fantastic investment solutions on board, competitive pricings, and world-class money managers. So we've got about 75 years, in excess of 75 years of experience selling on the insurance side as well as the investment side of the business, with about 5,000 employees and about $7 billion in gross premiums. So in terms of the Beneva's product offerings and so forth, in terms of the investment solutions, really, it's important to have a one-stop shop where you have the investment accounts. And I'll sort of elaborate a little bit on the investment accounts, some of the competitive advantages where you do have, particularly now and going forward. So in a low growth environment, in a choppy environment, you may want to further look at the Beneva's investment accounts. We do offer you true seg investment strategies under the Beneva's GIF platform that incorporates non-registered accounts as well as registered accounts. And then we've got GIAs, equity index GIAs, annuities, etc. But the reality of the products that we're offering is really about managing risks, I think, more than anything else. That's the value proposition that we do bring. And we also give you the advantages of offering built-in flexible estate planning strategies as you incorporate your practice going forward. So in terms of saving time, I'll be just elaborating on our investment accounts as well as our sec funds. And then maybe perhaps other opportunities that arise, which I'm privileged to be a part of, Experior, and host today's presentation. We'll a little bit elaborate on traditional GIAs, equity index GIAs, or give me a call and we'll be more than happy to guide you through it and coach you through that aspects as well. So sales is about storytelling, right? I like to tell stories. I think they're memorable. And they resonate. At the end of the day, our value proposition as financial advisors is really about managing risks, right, in the current market environment and going forward as well. Risk management seems to be important with looking at the differentiations between the two products. So I know the slide is a little bit old, but it tells the same story. Beneva's investment accounts, again, formerly known as Le Capital, offers you creditor protection or the potential for creditor protections, increased level of confidentiality versus your traditional mutual funds. And I had to scratch my head initially when I started my career with Beneva, but I figured it out. So basically, when you go with banks, a client passes away, it gets probated, it becomes public knowledge, versus Beneva's gift products or Beneva's investment accounts. It straight goes from the account to the beneficiary, bypassing probates, and it's more confidential. Sometimes whether you have clients that have family issues, they want things to remain private in terms of their asset distributions, then that could all matter significantly. So avoid probate fees is important. Both lines of business offer it versus mutual funds, they do not. And more importantly, um, all of our funds are socially responsible, right? Across the board. So perhaps you might be aware, you might not be aware. This is a thesis that's going on both on the institutional side of the business. We're getting questions and interests around the environmental social governance. And then there's really two sides of the bucket as we may speak is one that says, look, I care about the environment, environmental social governance. Then there's those other investors or prospects that say returns are far more important for you. But at the end of the day, we've got a combination that you can utilize at your discretion, of course, you and your client's choice. Buy low, sell high. One of the oldest investment cliches around and often sounds simple, but it's hard to do. The reality is there's two drivers to the market, fear and greed. Nothing more, nothing less. You open the media, look, you know what? Uh, there's a lot of volatility, a rising rate environment, a lot of pessimism in the news markets, geopolitical risks as well. We speak, which me and Sheldon were sort of alluding to earlier on in the call. So there's a lot of challenges, and those challenges sometimes create opportunities for mispriced securities. So to make things simple is basically to say, look, you're seeing a chart here from 1960 to about December of 2022. The green bars underneath it, what you'll see is the bear markets. In case if you're not familiar with what the definition of bear market is, it's when the market declines for about 12 to 13 month average, give and take. The medium return, or in other words, the average return is about minus 30%. So that's where the green is. So these kind of charts are ideal. I remember being out in the field with my senior VP back in the day when I was getting mentored, and I met an advisor. We probed to understand their needs, their portfolio construction, where there was a gap or what they were looking for to substitute it, whether if it's a value play or a growth play. I did everything right, or at least I thought I did. He looked at his watch and said, we've got about 20 minutes before we head out to the next meeting. Why don't we meet at Tim Hortons, which is just across the street? He said, Shant, you did everything right. But he goes, you failed to leave something behind. And that's still after maybe, I'd say 12 years, 12, 13 years, that still resonated with me, that we're visual. I learn visually. So saying what you're saying is not enough. Leave something behind, or at least show it, right? Take out your bag and show it and kind of showcase the pace that during market volatility, which is the green, that's when you got to be building positions. So when you hear the media telling you it's a bad time to invest, get out of the markets, stock market is expected to crash, usually it might be a good opportunity to dollar cost average and get into those markets during its weaknesses, right? Because what you'll realize is when you're starting to build positions, okay, for your clients, when it's green, right, during the bear markets, the rallies are represented by what we call a bear market, which is represented by the blue. And what you'll come to realize that the average duration, average length of the bear market, that's market that's going up, is about 53 months with a medium cumulative return of about 107%. So while all the pain, again, it goes back to emotion, right? We're creatures of habit. We make decisions based on emotion. So when we get nervous during the bear markets, because there's a lot of pessimism, clients are looking at their statements and thinking, wow, I better get out of the markets. I better go into GIAs. Let's find out which company is providing you the best annuities or high yield accounts. Now is the time you really start to position it for that recovery. And as you could see, the recovery comes even stronger than the bear market. So keep these things in mind. I think that that's important for you. Over a 20-year period, $10,000 invested for the TSX here in Canada. If you stayed fully invested, that $10,000 would have grown about $50,000 approximately, right? $50,873. Now, if I thought I was smarter than the market and I started time the market and all of a sudden missed the best 10 days of the market, my returns would have been cut in half. So the 10,000 would have grown to $27,000. Chances are I would have come back and saying, what happened with the portfolio? How come I didn't make enough money? Right? My colleagues made a lot of money. My relatives made a lot of money. How come I didn't do it? It's because you're starting to time the market. So I always say it to our colleagues in the when I'm hosting webinars or seminars in general, it's always time in the market, not timing the market that really matters, right? So reduce the emotions of investing, stay focused. Remember, this is a long-term game, right? You're invested there for a reason, right? All of a sudden, when volatility comes, our time horizon shortens. That 10 years becomes all of a sudden 2 years, year and a half. Get me out of here. Let's wait and see what's going to happen. Then we get it back into the market. It's that kind of a mindset that allows you to miss those best days of returns. And once it's gone, right? You got to wait for the next leg up. So here, I want to give you an illustration, right? Like I said, sales is a little bit about storytelling, and that's how your audience and your prospect and your clients start to remember. From November in 1983, and this is on the left-hand side at the top, highlighted in yellow, November 1983 to July 1984, for 8 months in a row, right? The market declined 15%. So 15%, guess what? The media is saying sell, 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 get out of the markets. I call my advisor and I say in June of 1984, and I say, I had enough. Pull me out, put me into money market, put me into GIC. I'm taking my money, going to the banks, right? Comes July of 1984, just across it, from July 1984 to August 1987, markets rallied for 37 months at about 150% rally. So the same scenario applies on October of 2007 to March of 2009. 17 months, the market declined minus 53%. There must have been a lot of redemptions. A lot of advisors were working extra hours, right? Trying to handhold investors, right? Stay put, stay focused. But just imagine if February of 2009 and I pulled the trigger and redeemed. Now, March of 2009 to April of 2011, for 26 months, the market rallied 95%. So what you're getting from the messaging, and there's a lot of information here. The message is very simple. During the decline, buy more units, capitalize on opportunities, okay? Because when the rally comes, it comes much stronger. If there's nothing else that you can take away from that, take away from these two slides, those important distinctions, okay? And I think that that's important for you. Here, it'll tell you, look, you know what? This is the S&P 500, and it grew from 1985. You had some volatilities. You had the financial crisis. In April of 2000, you had the dot-com bubble, Black Monday, right? You had the crash in 1987. So there's always reasons not to invest in the market. There's always something going on, whether if it's geopolitical risks, market risks, interest rate risks, whatever it might be. At the end of the day, the reality is, right? Stay focused, because what you're seeing, history tends to repeat itself. There will be volatilities, there will be choppiness. Those are opportunities to buy in. Okay, so keep those things in mind. I think that they're really, really important. Little bit of the similarities and distinctions. We'd love to win Experior's non-registered business as well. We thank you for all the support that you've been providing us on Beneva's investment accounts. We do appreciate it. We realize it's a highly competitive environment. So that being said, with Beneva's investment accounts, formerly known as the Le Capital, it's ideal for the mass or middle markets, right? So the ages of 18 to about 74 years, give and take, primarily focused on building wealth. Looking for active managers, which is very, very important, and I'll allude to in the next few slides about the importance of active, and I'll define it, okay? World-class money managers, from CI to Fidelity to AGF to TD to you name it, to Dynamic, right? Let's not forget our friends at Dynamic with much lower fees. So if you're in the camp and you believe, next year you're heading into a volatile time, a little bit of choppiness, what you want to do, in my friendly suggestion to you, right, from my past experience, is always keep the fees low, stay competitive, right? Now, you can use your traditional seg funds and keep the MERs at 3.5%, right? Nothing wrong with that. Every product in itself has the pros and cons and has their strengths in it as well, right? On the Beneva's gift products, right, which is for non-registered accounts as well as registered accounts, could be ideal for maybe some of your advisors that are utilizing in the non-registered account. Therefore, ideal for preservation of capital, mature clients, right? You've got the death benefit resets as well as the maturity resets in the seg funds, right? Beneva's gift products, whereas Beneva's investment products, you just got the 100% contribution amount from 18 to 74 years old. And from 75 years old to 100 years old, you've got a 75% death benefit guarantees. Some of the competition is telling you, you know what, with that 75% death benefit guarantees for clients that are 75 years old to 100, you might get a higher death benefit guarantee, but there's a catch. The catch is you're limited in terms of the funds that you can provide to your clients. Versus us, it's open, right? You can fully invest without any restrictions, without any limitations whatsoever. So keep that in mind. I think that that's important for you in terms of the distinctions. We've got multiple asset classes. It's a busy slide, but what I would tell you is probably, fixed income, balanced funds, Canadian equities, US and global equities, portfolio funds, right? From AGF, element portfolios to dynamic edge portfolios. Set it, forget it. Don't worry about where the market is headed. Let the portfolio managers navigate it, right? And capitalize on the opportunity. I think that that's important for you. We've also reduced our minimum from $500 to $400 per account, and those, in terms of the death benefit guarantees, I've illustrated it, and I think that it's a great product. I really have convictions in it. So from 18 years old to 74 years old, 100% death benefit guarantees. There's no resets on those death benefit guarantees. From 75 years old to about 100 years old, you've got 75% death benefit guarantees for any contributions made from 75 to 100, right? So if your client is 74 years old and they put in 100,000, they've got 100% death benefit guarantees on that 100,000. They're 75 years old, 76 years old, they put another 100,000, they've got a 75% death benefit guarantees on the other 100,000. Okay, so just sort of to clarify that, and for Beneva's investment accounts, it's mostly registered products. Okay, not mostly, all of it is registered products. So I got to be careful here. So RSPs, RIFs, LIRAs, LIFs, and TFSAs. So in terms of the funds itself, we believe in quality versus quantity. I think, you could, we've got about 40 plus funds here. The reality is, look, you could have about 80 to 100 funds. If you think about it logically, the reality is all the portfolio managers are looking for the best opportunities, right? Whether if it's in the information technology sector, healthcare, financials, and I'll tell you a little bit about the financials. I did a wealth webinar yesterday with Fiera Capital. I'll tell you about how they're capitalizing on the financial sectors. It's a sector that's seen some headwinds. But again, what you're seeing right now is world-class money managers. So what you're seeing in the center is the reference funds, okay? Those are the mutual funds that we mirror. Now, when I say mutual funds, you got to be life licensed to buy our products. Okay, not MFDA, but life license. So let me go to balance funds. Let me go third from the bottom, Fidelity's monthly income fund. Okay, one of the more popular ones among many brokers. So Fidelity's monthly income fund, on the right-hand side, the MER is 2.29. So if you Google Fidelity's monthly income fund Series A, you'll get an MER of 2.29. That's exactly the MER that we offer. Very low, right? Very competitive, right? Particularly in a low growth environment, that's what you want, lower fees. You don't want higher fees. Higher fees will eat away at your return, right? So look at it that way. So, you've got AGF's global dividends, you've got Fidelity's Canadian dividends, we've got Dynamics Canadian equity income that's done fairly well with an MER of 2.13. Again, very competitive for those looking for income-oriented investment strategies. Again, the incomes don't get spit out, right? They get reinvested within the SEC platform, but they mitigate risk. They reduce volatility. So going forward, I think all these dividend income equity types of strategies are ideal. Large cap ideal for the current market environment that we're going into. On the far left-hand side, where it says the type of account, right? That's Beneva's investment accounts. That's what we titled. So we call, for example, under the balance, the third from the bottom, it's called diversified income in bracket Fidelity. So if you're scratching your head and you're kind of thinking, okay, which fund does that mirror? That mirrors Fidelity's monthly income fund with an MER of 2.29. Same portfolio manager, same MER, same performance as the mutual fund. You got to be life licensed with the benefits of SEC estate planning. Typical advantages that a SEC fund offers you. So those are important to you. Fiera has been phenomenal. Fiera has been, I would really tell you, look at Fiera's, this year they've been rock star, but they've been very consistent throughout the year. It's not just about a year-to-date returns. I would probably tell you, put on your radar the Fidelity's American Equity by Fiera, Fiera's Global Equity, and Fiera's International Equity. I don't want to be biased. There's a lot of good money managers out there as well. AGF's Global Equity is another one to put it on your radar, but very, very, very consistently. So what's happening in terms of the financial sectors with Fiera in the United States and globally as well? If they're looking to play the US, the financial sector market, they've got some positions in the banks. But more importantly, they're going with companies such as Moody, for example, right? Or big research companies that are outsourcing their researches and they're getting monthly subscriptions. The monthly subscriptions that they're receiving these companies is consistent, steady cash flow. And that's what matters, right? So that's another way of saying, instead of just looking at the banks, you could look at other alternatives within the financial sector. So I found out intriguing. Fiera has stock positions, so underlying holdings, anywhere between 20 to 35 names. So very concentrated, high conviction approach to investing, right? So when they're making the bet, they've got strong convictions, right? You don't got this old over diversified about 100, 150 stocks in there. You're kind of scratching your head and thinking, wow, somebody's got to be doing good. Well, you got to have some solid research behind you to include 20 to 35 stocks at any particular time and capitalize on those opportunities. So those are important for you to take a look at. Again, we get into the type of portfolios. We've got AGFs, we've got conservative dynamics. So we've got AGF's element yield portfolio, dynamic edge defensive portfolios. They could complement a GIC. They could replace a GIC over time. So again, if you look at some of the trends out there, what you'll notice, either was National Bank or Canadian ETF Association, I'm not quite sure, but there was a slide that showed the influx in the last 2 months going into Canada, international, and the most of it going back into fixed income. Okay. Now, although we're talking about GIAs, we're talking about interest rates and yields and all that wonderful stuff. If the thesis is right, in other words, if the market is correct in a sense that it's saying to you, you know what, the second quarter of next year, interest rates will gradually start to decline, right? Federal reserves will start to lower interest rates because we might see volatility in the current market environment. The way to stimulate the market is really to reduce interest rates. That would be beneficial for equities, and that would also be beneficial for fixed income. So I'm thinking, could that be the rationale around that? Just maybe or maybe not. I'm not quite sure, but that could be some that could be a good position in in the next couple of quarters for you to think about. You've got balance mandates that you can set it and forget it, right? Simplify your business, particularly for all those that are new to the business. You're looking to grow it, or you've got a part-time job. You want to run an efficient, clean book practice. Then perhaps these managed solutions are set it, forget it, collect the revenues, give a peace of mind to your clients, right? Reduce the emotions of investing. That's what you got to do, right? Rather than have that conversation of, okay, this particular mandate is not doing well. We're having some challenges. Should we be getting out of that position? Should we adding, elsewhere? At least it gives you an opportunity to set it, forget it while you're prospecting, you're building your practice. So a lot of the newer advisors that were getting into the business were able to utilize managed solutions. There's no doubt about that. So if you look at the year-to-date returns, American Equity by Fiera, Fiera's Global Equity, and Fiera's International Equity, by far, they're doing well. Now, here's the catch, okay? Just imagine this year in January and February, a lot of the advisors were saying, I don't know, I think it's going to be a little bit of a choppy market, right? It's not going to be good. So let's hold on to cash. Let's go back into GICs. Let's put it into money market, whatever it might be. Just put it on the sidelines until we figure out what's going on. Look at the returns, right? From 11.28% to 6.28%. Dynamics is almost Dynamics is around 6.28%, roughly, give and take, if things are right, or 4%. But nevertheless, what I'm trying to tell you is that, you know what? Don't miss out on the opportunities. Don't time it, right? Capitalize it and have convictions and believe in the portfolio managers that they're actively managing this, right? The difference between the retail investor and prospect versus a portfolio manager is the retail investor and prospect gets emotional, right? Get me out of here. I've had enough. Get me out of the markets, right? Let's redeem. Versus the professional money managers are able to capitalize on those missed opportunities. They think, you know what? That's an excessive sell-off in the market. It's a great opportunity for us to buy. That's the difference in mindset. And if we can coach them, right? You're not just a financial advisor now. You're an emotional coach, right? So it's not enough to talk about portfolios, but it's enough to kind of get them to not time the market and get into the markets and capitalize on the opportunities. And that's what I think is important for you as we go forward. So the importance of active managers. What do we mean by active managers? Well, something that's looks different than the index. Okay. Sometimes active managers get the heat, right? And they say, you know what? Active managers underperform the index. So maybe the competition, the banks are going with ETFs, index ETFs, right? And I'll show you a little bit of what the rationales around the ETFs are as well, and give you some sound bites that you could fight against banks. The reality is, if you got some great portfolio managers with research capabilities, over time, you can outperform them. The case in the pudding. Beneva's American Equity by Fiera. The blue line is represented by investment, right? Which is the Beneva's American Equity by Fiera. Category average is the yellowish. Index is red. So significant outperformance, right? So now do take into consideration, there's the fees for Beneva's American Equity Fiera versus non-fees for the index, or very low fees for the index, right? So that's the differentiation. So imagine with the low fees, we're still outperforming them. So Beneva's Global Equity by Fiera, again, the same scenario here, outperformance significantly, right? If you invested $10,000 in 2015, that would have grown to $21,000 versus the category average at $13,000. So you want to talk about convictions, you want to talk about portfolio constructions, you want to be able to talk about it. They're able to execute and mitigate risk. Here are the portfolios I'm giving you, right? They're not going to do well every single time, but over time they will do well. These aren't the only solutions, so I don't want to be biased towards these solutions, but I want to sort of illustrate and give you when your prospect is going at the bank and buying an ETF index, right? These are the slides I would show. This is the ammunition that I would use, right? And I think that that's an important distinction. The second important distinction I hear, I'm traveling around a lot and hearing about ETFs is, I would say, what's your buy and sell discipline? So if the bank, if the advisor has an ETF, what's your buy and sell discipline? When do you know to buy? When do you know to sell? And get out of the markets and protect on the downside, right? So you got to be right twice. So when I hear, raising cash, you got to be right twice. One is that if the market pulls back, your timing has to be exact, right? And then when the market corrects and goes up, starts to appreciate, your timing has to be perfect. So you got to be right twice. That's why it's a very dangerous game to have cash on the sidelines. You can capitalize on opportunities, but you can't get the timing perfect. And then we've got, I didn't want to be biased here, folks. I wanted to give you AGF's Global Equity or AGF's Global Select. Again, phenomenal returns. The blue lines represent the investment versus the category and index. And this is from our friends at Morningstar. This is the convictions and the importance of active managers, right? So we could own stocks, right, that the index doesn't. We can have less weighings of that stocks than the index or more, or not hold a stock that's found in the index. If you do all those three as a portfolio manager, you're able to capitalize on that. I don't expect you to tell this to your clients, but I want you to showcase the importance of why you're hiring these money managers to be able to capitalize on these kind of opportunities, right? Dynamic is no different, right? So Dynamic is a great money manager. I could have included Dynamic in here as well, right? CI, Fidelity, the list goes on. But these are few illustrations to show you the significant outperformance versus some of the investment solutions as we speak. Now we get into the revenue component of Beneva's investment accounts. We've got no load, right? So no load is basically zero commission upfront, and you got trailers. So you got 1% trailer for equities, growth balance mandates, and then moderate to conservative is about 0.75% trailers. Chargeback threes is 3 years, okay? As well as chargeback 5 is 5 years. I'm sure many of you are familiar with that. So the upfront commission for chargeback 3 is 3.75. And then you've got the moderate and conservative portfolios paying you around 2.8% upfront commission. The 37th month, your trailers will start, okay? On the chargeback 5 years, upfront commission is around 5.25. Year 4, which is the 37th month, 0.25 for equities and growth balance mandates and aggressive profiles. And you sort of get the indication here. Now, certain companies may pay you less, may pay you more, right? This is where I would tell you, be cautiously optimistic. right? So when company says they're going to pay you a little bit more on chargeback 2 years, chargeback 3 years, than say Beneva does, for example, right? The reality is, look, you got to go back to the wholesaler and kind of say to them, okay, that's fantastic news. Now, when I'm putting my clients into chargeback 3 and chargeback 5 years, I'm taking a business risk. And that's the reality. We are taking a business risk, right? Because chances are your clients on, the second year of a chargeback 3 years, they could say, you know what, my wife got sick. They let me go at work. I need the proceeds. Who's on the hook for it? The advisor, right? That's a fact. So what we've come up with at Beneva is to help you keep more money in your pocket. So let me give you an illustration. This is chargeback 3, okay? 12 months out, 1 year, okay? The client says, I need the money. So 12 months out, Beneva, you have to pay back 67% of your chargeback versus leading company A and B, it's 100%. So in 1 year, you got to bring back all your commissions, 100%, pay it back to them versus us, you're saving, right? Still money in the pocket. Now, 2 years out, which is month 24, right? And that's exactly 2 years. You pay back only 33% versus 52% for company A and 66% for company B. So keep these things in mind, and don't hesitate. I think it's beneficial to know about it and to utilize in which partners that you're going to be capitalizing on. In terms of Beneva's GIF guarantees, formerly called SSQ, there's three types of three types of guarantees. There's the basic guarantee, which is the 75/75. Again, for non-registered and registered side of the business, you've got you can open it up until the age of 90 for the basic guarantee and contribute until the age of 100. You've got enhanced guarantees, right? 75 100s. You can open and contribute until the age of 75. Maturity resets are twice a year upon request of the advisor or the client, and you can request it until the age of 85. Death benefits automatically reset until the age of 80 every 3 years. So the maturity resets and death benefit resets are identical for the enhanced and optimum guarantee, right? With optimum, it's 100 to 100, and you can open it until the age of 85. So keep these things in mind. I think that they do come handy. Again, world-class money managers from Beetle Goodman, and I came across Beetle Goodman, solid, particularly in the US space, solid. I used to compete against the brokers there, and when they used to tell me on the US sleeve that you had Beetle Goodman, I was like, not good news for Shant. So Beetle Goodman is very good. I would tell you again, look at Fiera Capital. GQG is phenomenal. They've had a really good track record. They've been in existence for a long time, but with Beneva's gifts, they've been, they have a short-term track record because they've just been included within the platform itself. BlackRock Index, if you want to keep the fees though, you can go with BlackRock. Jarolowski Fraser value play is perhaps just right, just good during volatile times. Jarolowski Canadian equity has done really well. C Worldwide, I don't know if many of you are familiar with Fidelity's Innovation Fund. So C Worldwide has about, I'd say probably anywhere between 30 to 45 stocks in there, focusing on innovation, right? When we get out of COVID, right? Innovation changed enormously, right? Zoom presentations, technology, innovation, all sorts of things that are coming along, artificial intelligence and so forth, the list goes on. C Worldwide is a world-class money manager, one of my favorites, on the non-registered side, okay? Then you've got PIMCO and et cetera that we're able to capitalize on. US BlackRock US index is top notch there in terms of the performance at 12.38, followed by Fiera's US equity, and then GQG Partner International Equity, and then Fiera's Global Equity. So if you notice one thing in trends, both on Beneva's investment accounts as well as Beneva's GIF investment solutions, right? For non-reg and registered, right? Fiera tends to be in the top 3, top 5. So they've done really well and they've managed it really, really well. Last year was a little bit of a choppy market for them, give and take, but then again, they were able to capitalize on opportunities that were mispriced. And once the markets rallied, they were able to capitalize and provide decent performance as we speak, right? So keep those things in mind. I think that they're important for you. We don't get this often, but I thought I'd sort of kind of let you know because we've landed a few big accounts with Experior, and we thank you for that. I've landed a few big accounts with Experior, and I thank them for that as well, for the support in a competitive environment, something I don't take lightly or for granted for that fact. We have Beneva's private wealth investment solution, so minimum 500,000, and per household, obviously, and no load structure and advisor chargebacks. Our advisor chargebacks for Beneva's gifts are 2 years, and there's no load. So those are the two options in terms of the commissions. Our advantages of Beneva's private wealth is basically, you work directly with the Beneva's private portfolio manager. You've got an institutional style of investing. We've got about 40 plus managers. Again, we believe in quality versus quantity. I think that's important. I've been in the industry for 20 years. Fortunate enough to be in the industry for 20 years and count my blessings. Sometimes you've got all these mandates. I used to see the mandates with their competitors, but a lot of the flows weren't going there. They were going into maybe, 6, 7, 8 funds in general. We're getting the more of the consistent flow. So we believe in quality versus quantity. Select based on rigorous and ongoing reviews and capital protection. Goes back to what's your value proposition? Why should I do business with you, right? My value proposition is I mitigate risk, right? Reduce taxes, something catchy, something that's relevant within the current market environment, something that's dear to the client's heart, right? Saving on taxes, right? Consolidating debt, managing risk. These are all important things that you should incorporate within your value proposition as we speak. Creditor protection, and then you got the various guarantees with the lower fees. So let me give you an illustration of this. So we've got SSQ's private wealth, which is now called Beneva. So I've got a balanced portfolio. My balanced portfolio for the high net worth client is 500,000 minimum. So instead of maintaining a 1% trailer, I've given up about 25 beeps. So I'm going to keep 75 beep trailer there. Okay. I've got a 60-40 mix. I'm not going to be too funky with the investment strategies. I'm not going to go gung-ho, right? Small mid caps and all these funky things, not in this environment, right? So steady Eddie wins the race, right? A little bit boring, but that's okay. I like boring. So we've got about 40% allocation to CI's signature corporate bond. You've got 20% into Jerry Lowski Fraser Canadian Value. You've got another 20 into the Fiera's Capital US Equity and Fiera's Capital Global Equity. This is the enhanced guarantee. So this is the 75-100. Okay, right above that on the left-hand side, you'll see it says options. Right beside options, it says enhanced. So that means it's the 75-100. So my intention was basically to create a portfolio that gives you net of returns, a pretty decent return, right? Net of returns. What you're seeing right now is the net of return, right? Lowering the volatility, well-diversified portfolio with an MER lower than 3%. So this one is coming in around 2.7%. So 2.22% MER, and then you've got the guarantees for the enhanced coming in at 0.52%. So 0.52 plus 2.22, if my math is right, around 2.74, roughly, right? So Net of returns, I'm getting 7.97, almost 6% on 36 months, and almost 6% on the 60 months, right? So I like those kind of returns. Now, I could have done a gross and jacked up the performance, impressed everybody, but I rather do something net and show you after fees what the client's expectations are, or the potential expectations with these world-class money managers. At the end of the day, maybe your colleagues that are a little bit more senior, they can help you create portfolios, or whether if it's Andrew Gardner, Jennifer Santos, Sam, or myself, we can help you construct portfolios, mitigate risk, whether it's on the registered side of the business or non-registered side of the business through the gifts. Okay. So what I wanted to do here is give you the client's experience. So the client's experience, as you could tell, sales is about emotion, right? And I've said it earlier on, and I could keep repeating it because it's true, right? From 2010 to 2000 and what is it, 23, give and take, year hasn't finished as well. Realistically, there's been only one time this fund has incurred a negative return, which is in 2022. Now, one can argue and say, yeah, come on, Shant, I see 2018 at minus 0.74. Let's call that a flat year. That's not bad of a year, right? So the idea there is to construct a portfolio. We don't have a crystal ball going forward, but to give you the best ideas, long-term ideas, convictions, and the rationales around that. Any wholesaler can come up to you and tell you, I created a portfolio that beat company A, X, Z, Y, T, whatever, right? That's not enough. Give me the rationales of why you created what you created. Give me the rationales, give me the thinking. As a wholesaler, give me your experience, your thinking, your logistics of why you've created what you've created, right? What is it that you see? Nobody has a crystal ball, right? None of us. I'm not going to pretend to be better than a portfolio manager. Don't get me wrong. That's not the issue, right? But if they can give you that ammunition, then chances are you might have that one-off client that says, well, Michael, why did you choose this portfolio? Why these mandates? This particular company has about 40, 50 mandates. You chose these funds. Why? Tell me, right? So then you can have some ammunition. And that's where the wholesaling comes into play, right? It's not just knowing our products, but able to help you deliver them, right? Simplify the message. We're not going to give you something complicated to send back to your clients. We want to give you something that's simplified to help you deliver it to your clients. We get into the issues of MERs, okay? And I've always said that I believe lower MERs are important for you, right? So if you've got an MER of 3%, which is the fee for managing the whole portfolio, for example, right? And you've got a fund that's net of return at 5%. Your return is 5 minus 3, 2%. So your clients are taking all these risks, all these things for about a 2% net return. But if I can lower that fee from 3% to 2% to 2.5%, that additional 0.5%, that 50 beat, will do wonders, right? Will make a difference. So keep that in mind. So management fee, in terms of the breakdown, I get a lot of good feedbacks in terms of how an MER works. What is it? What's the functionality of it? And the reality for MERs is basically, look, the green pie is management fee. The gray and the blue are admin fees and taxes, which we can't get out of, right? I hope we did for taxes, but we can't. So if you really break out the MER, there's those three components. So there's the management fee, which is fixed, which, by the way, is the largest component of the fee. So that is a fixed amount. That's why over the years, you don't see too much fluctuations in terms of the MERs, in terms of the fees. So this comes from advice, this comes from sales and trailers, this comes from marketing and promotions and etc. Right? The fund company has to utilize all those, followed by two variables. The first variable is administrative fees, right? Which is basically audit and legal fees. So they got to audit the accounting and all those wonderful things that go with bookkeeping, record keeping for the fund, right? Accounting costs, taxes paid by the fund, and etc. The other variable component, right, is taxes. So the two variable components are the smaller components here, right? Which is highlighted and showcased by the blue and gray. The largest component is a fixed component. So with that, it's about 252. Don't hesitate to reach out to me. I'd be more than happy to provide you these slides, email you these slides. But one thing I would tell you, this is an important slide. This and this are important slides. There's no doubt about it. So I hope that benefits you. I hope that benefits your practice. You know, on behalf of myself, my team, or our team, we thank you for your continued business support. We do truly value it. And I hope and I trust you found this beneficial. So for those clients that are on sidelines, right? Dollar cost average, get them in. Don't let them time the market, right? Let's wait until next year and find out what's going to happen. Dollar cost average and capitalize on the opportunity. And don't forget, this is a long-term investment. Back to you, Sheldon.
Thanks. That was very, very informative and very detailed. We have so many requests in here for your slides. I guess guys want to go over it. And of course, everybody should know that we do have this recorded. So it will be in the back office very shortly. So you can review it. If you, I'll be sending you the list of everybody that's attended, Shant. And if you want to send everybody a copy of the slides, that would be great. If you want to have a control of where they've gone to, or you can send them to me and I'll hand them out. It's your choice.
Whichever is more your choice. I'm more than welcome to send it to you PDF, and then you can fire it off, or whichever best.
Well, I just
Maybe I'll
figured that
forward it
way.
off to you.
Okay, I just figured if I give it to you, then
Yeah.
there's a greater chance you might want to communicate with somebody. I don't
You know
whatever.
what?
It's up to you.
Do me a favor. Send it to me, and I'll fire it off.
Beautiful.
Okay, and I'll fire it off. No problem.
There's also a couple of other questions that are in the chat, and Marcella said, "Have you ever compared the MER to the ones from the bank, from that the bank changes on the mutual funds account?" I'm just reading the question.
Yeah, you know what? Sometimes you could have a lower MER at the banks, right? How I would position it with the banks is I would always play it. I sort of would dumb it down, right? And I would say, the banks are very, very recognizable, right? Absolutely. I know TD. I bank at TD. I bank at Bank of Montreal. Well, that's great. Well, Sheldon, the MER, the fund and the MER that is being offered by the bank is a lot lower than Beneva's, right? Or not a lot lower, but a little bit lower. Let's put it this way. Well, fantastic. I'm just wondering, how would the performance been within
No,
the
okay.
fund?
I think
And then from
just
there, I would
and
elaborate on the benefits, the advantages. Sorry, am I way off or no?
no, well, you see, I have an easier answer than that. Okay.
Make it easier.
It's just I mean, the reason why the MERs are a lot less is because it goes along with the amount of service that you're going to get from the bank. So that's fine.
It's true. It's true.
You can have a lower MER, but don't expect that they're going to reach out to you to tell you that there's something happening with your account.
Yeah.
You're the one, you, Mr. Customer, are the one that is left to manage the account. You're hiring me to do the job for you. If that's what you want, that's the reason why it might be a half a point higher or something of that sort. And in the long run, that's not going to make a big difference.
Let me give you
I,
another thing. I love your point. You're absolutely right and well said, and I love the simplified. You're a great coach, Sheldon. The other thing is, look, I'm a financial planner at the bank. Okay, my title is a financial planner. Am I able to sell external funds? No. So I sell only TD funds. I sell only RBC funds. So when the flows mostly are going into those funds, they can maintain a lower fee. Keep that in mind as well. Just something for thought.
Yeah. And it's very interesting. I'll tell you, like, remember you started this whole thing off with it's all about stories.
Yeah.
So I'm going to tell you guys a story that I learned from my father. So we used to, in those days, we used to sell RRSPs before the banks had the opportunity to sell RSPs. And I'm talking about the 80s and before the 80s. People didn't even know what an RSP was. And I remember when I was selling RSPs back in the 70s, and you had to really explain to somebody what is an RSP, and they weren't sure, is this real? Isn't it real? And all that kind of stuff. And then all of a sudden, one day, the banks got the right to sell RSPs. And I said to my father, I said, we're done now. The industry is over. That's it. I'll never sell another RSP again now that the banks have it. And he says to me, settle down. He says, within a year, anybody that's gone to the bank, you're going to get back. And the reason is because they don't have the people or the ability to provide the service. And he was 100% correct. All the accounts came rushing back. And so you know what? The advantage of the bank is some person comes off the street and wants to give them a few $100s. Okay, that's great. Let the banks do it. Doesn't matter what the MER is. But if you really want to help build somebody and build their account out, this is what you need to do. You need to be able to say, okay, so the MER is going to be a little bit higher, but the service that I'm giving you, the ability that I can do all of this, and I can move you to all different kinds of accounts, and there's no restriction, and so on and so on and so on, gives you the ability to be able to move your account and make sure that it's going to be doing the best thing. And I really think that that's where it is. We provide the service, the banks don't. That's all. That's the bottom line.
In the absence of value, price is the only thing that matters. Remember that,
Very
right?
good.
To our guests who are watching, you got to be able to position yourself as the valued advisors. Price is secondary or third on the thing. So remember that, right? In the absence of value, price is the only thing that matters. When they're able to see the value that you bring to the table, right, and Experior brings to the table from its financial capabilities and strengths, you know, I think you know, a little bit higher in price, a little bit lower in price, it's not going to make a difference really. If they like you, they see the work you're putting in, they see the holistic approach that you're doing, you know, financial planning from a perspective, you're trying and you genuinely care. Price is not the biggest issue, believe it or not.
Yeah, 100%. Thank you so much. Really
You're welcome.
appreciate it.
You're welcome.
And we'll look forward to your next presentation because they're very, very informative. So I
Very well.
really do appreciate it.
Thank you. Thank you.
All right, you
So
take care.
email me, send me the information, I'll forward it off to them, and have yourself a wonderful evening from here, lovely Sudbury, heading back to Toronto tomorrow, and take care. At least staying warm.
Yeah, exactly.
Take care, guys.